What is up? We're going to yap. We're going to yap about something new, and by the end of it, we're going to have a maybe not quite a model, but at least a dashboard that we can use discretionarily, no matter what time frame or whatever you use, whatever you trade, as long as you are trading indices or U.S. equity markets. It may help. What we're doing is a cross-asset correlation dashboard. That may sound a little bit like a buzzword or like a kind of a confabulated term to sound sexy, but it's literally, originally I called this macro dash, and I thought it was, I just called it macro dash because basically I just wanted to look at entry points on the S&P 500 or extremes in the S&P 500 or turning points in the S&P 500 based on some various things, any indicators I could find, not traditional technical indicators, but stuff like volatility, credit spreads, some other correlations we'll get into. And I call it my macro dashboard. It really had nothing to do about macroeconomics, except maybe for the interest rates part. But so I renamed it cross-asset correlation dashboard, XCore for short. So I'm going to just yap about it. I'm going to put some notes in a doc that will just be open. But the overview of this is basically, I started looking at this probably in mid-2024 or late 2024. What happened was I had to do some, life stuff, and I was offline for like 1 or 2 weeks. And I was, while traveling and doing a bunch of stuff, I wasn't in touch with the news. I wasn't in touch with the normal, market data I look at on a day-to-day basis. And I just, look at the market one time and it's just like stuff is blowing up. And what it was that in July 2024 and August 2024, the yen carry trade was blowing up. The Japanese yen was blowing up, and it kind of, carried over to some other stuff. It led to a big dip in the S&P 500. I think it's right before the Fed kind of changed from higher for longer, and they started cutting rates actually right after that. But I was in a spot where it was like, gee, I wish I had at least some context here. Like, how can you take all the crazy stuff that's happening in the market and distill it down to a few key data points or a simple model that will tell you, like, hey, are we complacent and about, liable to sell off, or are we in a bull market and it's strong, are we at a time of extreme stress and a turning point, or what, I don't know, there's multiple ways to kind of categorize that stuff, but I mean really there's only so many things you can do. And when I was first looking at this, it was interesting because I would look at kind of traditional technical indicators or some other stuff where I thought the S&P reversing, going up and then reversing to the downside and going down and reversing to the upside. I thought those were the same exact thing but the inverse of each other. I don't think they are anymore, not according to the stuff I found out. If you look at a couple of indicators, just 3 or 4, you'll see that kind of reversals from a big period of stress and like a sell-off, the reversal into the recovery in the bear market is kind of a different process than the market becoming complacent and just starting a new sell-off. It's really different, but that's a little bit of a background on it. So like I would use it. You can use it if you are a scalper, if you're a systematic trader, to kind of get your bias. You could use it if you're discretionary, of course, and just trade futures off of it. You could use it if you're in a retirement account, unleveraged, long only, to pick some bottoms or something and pick times to maybe not sell, but at least lighten up on your portfolio. So that's the background is, hey, is there something that can at least give me a heads up if I'm like, in the middle of the Sahara Desert and I can only get 4 or 5 data points, like on a cell phone or something. And really, I'll just say what it is up front. It comes down to the VIX term spread, which is volatility. We'll get into that. We're just going to break these down one by one. A credit spread, breadth, and then this is kind of a little cherry on the top. It's kind of really rare. I wouldn't expect it to pop up very often, but it's literally the correlation or the correlation with the volatility of volatility. Sounds pretty schizophrenic, but you'll see what I mean. It's uncanny. I wrote some notes in here, but really I'm going to keep it simple, and I'm just going to look at these things and then bang them out. When this started, basically, I looked at this one thing as a strategy in and of itself. And there are strategies you can use, you can employ from this indicator by itself, but I won't get into that. Then, and I heard about this like from one person, then I saw another person mention it, then I saw other people mention it, then I looked at it myself and I could see it in front of my very eyes basically call a bottom, and I was like, holy fuck, I'm gonna use this. Then I heard about this. Again, I heard one person mention it, and I didn't care. It sounded a little, academic and too like a macro economist. Then I heard another person mention it and actually use it in an indicator that was pretty good, and you can use to make money. And then also, I started looking at that as well. This other thing, I only looked at that way later, but it was really great for calling bottoms. Maybe not. It doesn't really have anything to do with tops or anything else, but great for calling bottoms. This is I'll show where this came from. Basically, it came from a person on Twitter. So you can use these things on their own. They may not. This would probably be the backbone of it. You can use them on their own. As you go down, they're less usable on their own. And I don't have a formulaic strategy where it's like, when this hits -1 and this is going from 10 to +10 to +8, then you wait until this does something. Like, I don't have a arithmetic formula for these, but I do put them together on a spreadsheet. And then when you look back in time at times when the market has very prominent crises, like Volmageddon, COVID, the yen carry trade blow up, in between COVID and yen carry trade, there was a Silicon Valley Bank crisis, which was kind of not as interesting. And then there's also the British pound had a little blow up somewhere in there. Anyway, if you just put a couple of these out on a chart and then you look at the major events and you just purposefully overfit and you go, hey, how could I have figured out when this was going to happen? It'll kind of come together where it's like, hey, maybe there's not a formula for it, but you just kind of see, hey, do I have 2 out of 3 of these things? Yes or no, and then it might give you a little heads up as to when a good, recovery is about to take place. These are, the top 2 or 3 or 4 out of a bunch of things I tried. And you'll see in the notebook kind of some of the stuff that I pull, but this is an example of kind of how I reverse engineered it. I brought some of the things together, put conditional formatting on it, put dates on it, brought in like, hey, what event happened here? What was happening here? What is this? Hey, Dixie bottom. VIX term structure goes negative. And I just put in a bunch of notes and just scrolled through it and just looked at it with my own human processing. And that kind of gave me some ideas of how to use it. But anyway, this is way more than enough background to understand now. I kind of have a inkling about other stuff that would work. There was a lot of stuff in here that I thought would be really awesome, like, the Trin or the ARMS index, or highs versus lows, Dixie, gold, and like some stuff just didn't jump out at me, and so this really is like me just using the most obvious and common sense stuff. One thing that I haven't tested that I would look at would be the cross asset volatility of FX oil bonds. I do have the MOVE index here. There's an index for oil volatility. I don't have an index for FX implied volatility. Actually, I think I downloaded that. Hang on. I'm going to see if I can find that. Yeah. I have no idea where it is, but okay. Yeah, the problem with using like rolling standard volatility of Dixie or Euro USD is it's backward looking, and there is implied volatility for FX. I don't know if it's based on the options on futures or if it's over the counter or what. That is a side note, and there's many side notes in here. Anyway, I was also going to look at short-term interest rate futures. I tried looking at do they indicate what regime you're in? It could be almost I was really interested in stirs if they're going up while the index is going up, or if they're going down while the index is going down, or if they're going opposite each other. I feel like that kind of indicates different things, different drivers. It could probably be similar to the yield curve, or like bonds steepen or flatten or whatever, but I really don't have a good handle on that, so I'm purposefully staying away from it. But we do have the bonds volatility, and we do have the credit spread, which is similar to that. Anyway, I'm going to throw this in here. what is it? FX volatility. Put it here. Actually, I need to look at this. Yeah. Oh no. Oh no. Okay, I'm going to make a giant data frame. Not really giant, it's just daily data. Oof. Okay, so one caveat here. There's a lot of caveats, but let's just go through them part by part. these closing times are different times. This is just daily data downloaded manually from TradingView from different providers. More caveats on that later, but yeah, so some of these are like, hey, what are these anyway? Data. So SPX, it's saying, hey, this is 1430. It's probably the open time. Then Forex.com gold CFD. One of the caveats is I was going to use the S&P 500 CFD from somewhere because it's real time on TradingView, but then I was looking at that against the futures and it wasn't matching up. So I just got the futures anyway. So this is like UTC close, or New York close in UTC, I think, more or less, and then this is New York open. So it's like, and this is SPX and this is gold, but it's really sounding like they're saying like, hey, this is the open time, this is the close time. They're 8 hours apart from each other. We can look at this and just see, maybe back in 2008 they were just showing a single data point per day. Nah, they were showing open, high, low, and close. So I don't know why they do that. I can look at it, but yeah, I kind of just want to move on to more interesting stuff. Yeah, so okay, it changes with daylight savings time, but they're still benchmarking it to, maybe this is just arbitrary, I don't know. Anyway, yeah, why am I looking at SPX here? Like, so I have SPX and I have the future. It's kind of because I think sometimes the future gets super dislocated from the rollover or whatever. You could look at the future minus the index and find the, premium. But in reality, we're probably just going to use this anyway. Then this, I'm going to just go through it really quickly and just comment out everything we don't absolutely need. The skew, I looked at that, couldn't figure out how to use it exactly. It's just a little additional, maybe used for Confluent. Dixie, I didn't figure out how to use that. Maybe used for Confluence, but we do have FX volatility, which may be more important. This, the Russell breadth, is the one that I actually found useful. This I didn't find useful, this I didn't find useful, this I didn't find useful. One of these I found useful, and I can't remember which it is. And then this is a spread made out of ETFs that replicate one of these because it's real time, the others are not. Funny side note, I thought only a couple people knew about this stuff. Then just now I was on YouTube, I clicked into like a Saying Lucci video, and he was looking at HYG, or no, LQD divided by IEF. Which is kind of, yeah, I don't know, like, it's supposed to be a credit spread, but anyway, either he has it backwards or I have it backwards, but anyway, I just didn't expect Saying Lucci to know about this, but I guess, hey, that's a great sign that maybe other people care about it, that actually works. Move, we'll use that. These other bonds I'm not going to look at. I'm not going to look at oil. I'm curious about the volatility, but I'm not going to look at oil either. Gold, I don't care. I was going to look at that, but fuck it. So we're going to get focused. We're just going to look at the future. Volatility, we're going to make a term spread out of this. VIX, breadth, credit spread, proxy for the credit spread that's real time if you want to use it. And then these two I don't know about, but we'll look at those. Anyway, I'm going to just make a note of these here. So these are available on Fred, but ooh, that's TradingView. Fred and TradingView actually. They're published by Bank of America. So I think these are like a day late or something. Yeah, so today's Wednesday, right? Yeah. We only have the data from yesterday, so is it useful? We have to lag it to figure out, but this is a total return index, so it's kind of showing the return of high yield, I think, is corporate bonds. Yeah, investment grade corporate debt. And total return means it's including the payments with the actual movement, I guess, of the underlying. I don't really know. I haven't read this. I don't really know. And then this one, let's see if we can just go straight to it. Bam. Option just group. Okay, so this is actually something that I can understand. This is a credit spread, so it's how much is like in percentage points, how much is corporate debt paying you versus government debt. So like in 2008, corporate debt, like the higher percentage they pay on it, that means the more risky it is. So here, wow, the spread was 20%. That's because everyone thought that the world was going to end and the banks were insolvent. I don't know what the risk-free rate was then, but basically this shows a time of stress. Like, wow, whatever the risk-free rate is, we don't know, but corporate bonds are paying 20% more. That's insane. The dot-com boom, it was like 10%, year 20%. I don't know what this was, but then in COVID, hey, it was 9%, 8 or 9%. And then there was a little echo of that here when the Fed finally started raising rates, but it didn't really go anywhere. It was only a mild 5% spread. It got back up to 4.5% in April, Liberation Day, and now it's back down to 3. So it's actually quite normal. This maybe I don't know if this is useful as like a complacency indicator, but hey, if it's around 3%, if it's below 3%, that's really good. That means people are very certain that corporations are going to pay their debt, and maybe they're just desperate for returns. They can't find it anywhere else, so that's what drives it really, really low. I can't see other times where it was much below 3. I guess but before 0809, and back here I'm not old enough to know actually what it was like here. Yeah, so I'm kind of talking too much about what we're not immediately addressing. But yeah, I guess I'll just do this as an overview and then re-record the specific VIX thing. Okay, so now we're nice and focused. Let's see if I can do this. Just learned about this .dt.date the other day. Okay. I'll go ahead and drop time as well. Oh shit. Okay. Let's condense this. Boom. Okay. Okay, so we have ES, VIX, VIX. This I'm going to ignore. Missing this. It's getting named as that. Okay. Surprised that worked. Okay. Okay. Ooh. Okay. Okay. This is sufficiently dumb, but you're getting the raw, unfiltered truth here. Okay, so let's do this. Okay, So I'm going to sort this by first. So we're seeing, hey, for move, we got a bunch of data. For FX volatility, we only have up to 20, starting at 2020. It's kind of unfortunate. And it's way after COVID, so we may not be able to use this very much, but hey, it's kind of a speculative thing anyway. Everything else is fine. I downloaded it around last week, so really there were no major financial blow-ups, so yeah, we're pretty much good here. Yeah, so focusing in on the VIX, really let me find I'm trying to find something on TradingView that I can just totally fuck up. Okay, so get out of here. Okay. I'm gonna just start a new video about this.